Good afternoon, welcome to Amundi Fund Talks, another edition. And with us is Thomas Page-Lecuyer from CPR Asset Management.
Hello, Chris.
Hello, Thomas. Thanks very much for coming.
Welcome.
Thomas, what does gold mean for an investor and their portfolio?
Gold for an investor is the ultimate protection. Actually, compared to other traditional asset class, gold is concrete. You know, a gold ring, you can catch it, you can have it in your hand. At the contrary, it's completely different from a stock or a bond. You can't have it in your hand. It's not as concrete as gold is.
And historically, has it been seen that way? Or maybe the history of gold?
Yeah, actually, why is gold so concrete, so important for financial investors? It's because if you add a cube with all the gold ever mined in the history, it will be a 20 meters size side cube. Okay, so it's not that much actually. It's much less than a football stadium. It's like you know, a tennis court.
Smaller than the average house.
Yeah, so it's pretty rare. It's this scarcity which makes the gold so expensive, so important, and so valuable for investors.
Okay.
And you have to keep in mind that gold was mined 500 years before Christ and King Croesus. And it's still mined today. And it's recyclable. It means that maybe the gold ring you have is made with gold discovered and mined 1,000 years ago. You don't know. It makes it valuable.
Now we understand gold in the historical context and how it can be used, but maybe what does this mean for the institutional investors?
For investors, when you are talking about multi-asset investments, we think about bonds and stocks. But within our current market regime, with bonds and stocks very expensive and highly correlated, everything is expensive. We have to find diversification, which is uncorrelated, with less volatility, and which is independent from bonds and stocks, so that we think about gold directly.
Okay, so the diversification value is what's key.
Exactly. It's a diversification which is independent from traditional asset class, which means in case of a systemic or bearish market, you can have an edge against any decrease or drop in the market.
And diversification is the key, but how does that play in terms of correlation, so to say?
If you make a correlation matrix between all traditional asset classes plus real estate, commodities and gold, you will find easily that there is a huge correlation between gold and inflation, okay. Which means that you can find an edge here in case of a reinflation market regime, for example. Mm-hmm. Gold can protect you against inflation increasing suddenly. On the other side, you can also see a very low correlation of gold against stocks, treasuries, long-term rates, and real estate.
Okay.
So they are traditional asset classes within the multi-asset investment universe, so that it's a perfect diversifier against these asset classes in your own multi-asset fund.
So in terms of inflation and the changing stance of central banks and announced and unannounced potential rate hikes, what does gold mean in terms of inflation?
It's a key issue on financial markets. You have seen it at the beginning of February. We have experienced a bearish market about inflation expectations increasing suddenly. It is an issue for financial markets. We have to find an alternative. As Alan Greenspan said a few years before, the price of gold can be broadly reflective of inflation expectations, which is the case for more than 50 years now. Mm-hmm. So it's also a very good hedge against any potentially damaging effect of any monetary policy error. When I mean monetary policy error, I mean key rate hike in the United States. If it's too quick, too fast, it will be bloody on financial markets. We all know it. In that case, get gold to be hedged.
When is it best to play gold? I mean, can you use it in sunny day weather markets? Can you use it in a Goldilocks market? How does your allocation change?
It's a very good question. Actually, if you play gold as a pure asset class, it won't be less performing. It will be less performing than equities, for example, and more risky as well. However, when you use it as a diversifier, and when you choose the good period to play it in your multi-asset allocation, it will be a booster for your performance. And when to play it then? If it is a bullish economic and financial market cycle, it's not very interesting to get gold. But the best period to play it, according to studies for 50 years now, is during stagflation period. Stagflation means, inflation increasing with low growth. It is exactly the economic cycle we are entering now.
Okay, so the key is to be an active allocator to your gold position.
Exactly. It's not very efficient anyway to be investing in gold on the very long term to be optimal. You have to be active. Every month, your physical gold allocation, your physical gold weight should change given the market issues, political constraints, monetary policies threats, etc. In that case, if you play it well, between 0% to 30% of gold, you will be more performing.
See, thank you. So our Amundi Gold Mine, Global Gold Mine Fund, can be found on the Avanza platform. It can also be found on the Swedbank platform. And it is a UCITS Luxembourg-based product, which is registered in Sweden. So it's easily purchased on those platforms. And Thomas, I want to thank you very much for coming today to discuss gold.
Thanks to you.
And the potential allocation to the portfolio. Thank you.
Thank you.